Everyone's favorite ride hailing slash food delivery business, Uber, just reported Q3 numbers, and the market loved it with a 12% pop in shares during the morning session, despite missing on bottom line estimates. Year to date, they are down about 32%, and they are still struggling with profitability. So we have to wonder what Wall Street actually liked about this earnings release, and if this is a potential value investment opportunity for us retail investors to profit off of. Make sure to stick around because we'll be answering all those questions and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. We'll be starting with the full analysis into the financials. We'll go through the top line, bottom line, balance sheet, cash flows, all that. And finally, we'll conclude with an evaluation of this business using our intrinsic value calculator to see if Uber really is a buy. And if you enjoy this type of content, please subscribe as we post on here regularly, looking in depth on the various fundamentals of different businesses, making our investment conclusions and sharing them with the community. So if that interests you, please subscribe, like the video, and without further ado, let's jump into it. As always, we will start this video off with the comments from the CEO themselves, just to give ourselves a little bit more insight from this quarter. And the first thing that they mentioned here is that their global scale and platform advantages are working together to drive more profitable growth, with gross bookings growth of 32% this quarter and record EBITDA, despite the uncertain macroeconomic environment that they've been working through. They remain focused on excellent execution and disciplined cost management to deliver their growth and profitability commitments for the coming years. All right, so as you can see here, while revenues have been growing consistently year over year, besides our slowdown here in 2020 when everything was locked down, they have not been able to grow their earnings. And in fact, they've been trending in the wrong direction for the most part. However, they almost became profitable last year, and now this is why we're at an interesting point with Uber, because if they can turn the tables here, they're going to start to attract a lot more investors, and especially as you can see here, with their gross bookings, we can see these have increased quarter over quarter over quarter since Q2 of 2020, and they're only expanding further with their further investments into their freight segments and others. So let's actually just break all that down here. All right, so let's start with the gross bookings here, okay? We can see growth quarter over quarter, as we just mentioned. Actually, on a constant currency perspective, 32% growth year over year. How does that translate to revenue? Well, revenue has also been growing, okay? And so $29 billion in gross bookings equates to about $8.3 billion in revenue. Quarter over quarter, that's a 3% growth. But when we look at this from a year over year perspective, 81% growth constant currency. Massive growth, 111% the quarter before that, 141%. Like, we are growing at substantial numbers here for Uber, which really goes to show that the business model is working, but they're still not able to deliver profitability. But that is what they're working on here, which we can see in our next slide here. Clearly, if revenues are growing at such high rates, that also means their expenses are. And so what do you need to do in that case? If you're a business like Uber, you need to cut down on your expenses. That's what they're trying to do, okay? They're saying since Q1 of 2021, they've been able to decrease costs per trip for US and Canada in terms of the delivery segment by 25%. That's actually relatively strong. We're going to want to see that cost reduction expand further, though, if this is going to be a profitable business. You know, we can see this benefit here in terms of EBITDA, where they've been able to produce some positive numbers here over the past few quarters. And the good thing is they're saying this cost reduction should continue as they expect delivery to continue to benefit from growth of their advertising revenues and sales and marketing leverage. So that leads us to our segment results. Let's take a deep look. Again, 32% increase in terms of gross bookings. And in terms of revenue, we can see mobility or ride sharing. This makes up $3.8 billion. Food delivery makes up about 2.7. And then they've really been expanding their freight business. You might not even have heard about this, but essentially they're working to become the middleman of many transport companies. And clearly it's been working as they've increased their revenues from $402 million to $1.7 billion just in 1 year. And that is a number that has been growing. So keep that on watch as we might see this expand further, especially in the near future. Ultimately, that created about $8.3 billion in revenue. Let's expand on that a little bit further. Let's jump into our consolidated statement of operations. All right, so we have our revenue here of $8.3 billion, up almost $4 billion from a year ago. Costs of revenue are now up to $5.1 billion from $2.4 billion 1 year ago. So those have also significantly increased. And then once we add up all our other costs and expenses, we're left with $8.8 billion in operating expenses. That's why we're left with a loss of operations of $500 million. Still better than they were doing last year, but we can really see, especially when we look at this from a 9 months perspective, their costs are substantially increasing here. You know, about an $8 billion increase in cost of revenue, a few hundred million in operations, and another $500 million in research and development and general and admin. So we can see their costs are really ramping up, and it's how they've been able to produce about $23 billion in revenue so far. So we have to ask ourselves, at what point can they start to reduce these costs at a substantial rate, which won't affect the revenues? Because clearly, in order to increase these revenues at the rates that we have been, they've had to increase their expenses almost at the exact same rates. You know, they're going to struggle to become profitable. Now, let's look at the bright side here. Despite the pandemic, this is a business that was continuously growing with large numbers across the board, and they're really focused on their growth opportunities, making acquisitions, developing their products, products, and again, reducing their fixed run rate costs. And if we look at this from how they progressed over the years, gross bookings have expanded quite substantially over the past decade or so. Margins are improving. Their delivery business is growing. They're up to 3 times what they were back in 2019. They have more drivers than ever, more riders than ever, which is leading to higher engagement now, which is obviously going to translate to higher revenues in the future, not to mention some consistent delivery growth as well in the mid-teens. Additionally, monthly active consumers are growing still, 14% growth year over year. Trips are growing at 19% year over year. So there's a lot of different things Uber has going for it right now. They really just need to focus on becoming a profitable business. That's also not mentioning the different avenues that they're traversing through with trying to become more profitable by adding on advertising revenue, right? They launched this back in 2020. They were able to produce $11 million. Last year, they were able to produce $141 million from this segment. They're aiming by 2024, in the next couple of years, that they'll have over $1 billion just from advertising revenue alone. If they can achieve that, that'll really improve their margins and fundamentals as well. It doesn't cost a lot to put those ads on there. So that's another way they can achieve profitability. They're also targeting their Uber for Business segments, where it was primarily only mobility services that they were really offering. Now they're diversifying their portfolio. They're taking on some more deliveries, and they're expecting that by 2024 as well, they can reach about $5 to $6 billion in gross bookings. So all in all, what this presentation is really showing us is that they're really expecting to grow substantially from these levels, and that we're only at the beginning right now. And this is exactly what businesses that don't have profitability do, is they show you the future as if all their expectations and predictions come to fruition, but there is always that possibility that absolutely none of them do come true, and you always have to take these estimations with a grain of salt, especially when they're coming from the business themselves, because they are produced in a way that entices investors. That being said, let's jump into our balance sheet here, guys. $5 billion of cash on $9 billion in debt. It's not terrible at all. They have about $38 billion in total assets. And from a new and growing business, this is nothing that's out of the ordinary. Let's look at the free cash flow reconciliation now. We can see for this quarter, $432 million operating cash. Deduct our small capex figure, $74 million, and we're left with $358 million in positive free cash flow. And this is exactly what you want to see from a business that is struggling with profitability. What's their cash position looking like? Are they able to produce free cash flow on a quarter-over-quarter basis? As we can see over the past 2 quarters, yes, they did have some slowdowns back in Q1 and Q4, but ultimately they're producing positive free cash flow. So that's a positive sign for investors or potential investors. It's going to give them some leeway in the future to make some more acquisitions and really focus on building up this business from its early stages. Right below here, we have our financing activities. We haven't really done much, especially from a 9 months perspective, so we won't really touch on that. Finally, it's time to jump into our calculator, but before that, we have some estimations from them in terms of what we can expect up until 2024. And that's that they're planning to essentially double their gross bookings to $80 billion by the end of 2024. Right now, they're at 190. Let's just call it a double for the sake of our calculations, which we'll get into in a second. And so, with all that being said, let's jump into the calculator. So with Uber, they're saying they can double their gross bookings, but we've seen how that translates over to revenue and then to operating income. We're still not able to produce operating income. Right now, they're only able to consistently produce operating losses. So let's assume in the very best case scenario here, they're able to produce about $500 million in operating income with increases to all their segments. And if we require a 10% return, they don't currently pay a dividend, and they're able to grow at 25% for the first 5 years, 15% after that on a 40 PE. Yeah, this stock will be worth about $22 per share in a normal scenario. Now, in the very best case scenario, let's lose our 5-year EPS growth metrics of 32% for the first 5 years. Then we'll say that drops down to about 25% on a 45 PE. Yeah, this stock would be worth about $47 per share in the very best case scenario. So we would see some nice stock appreciation from these levels up to $93 billion in market cap. But if we really did produce about $500 million in operating income, given the current price, we would be trading at a PE of 118. So if we put that into our calculator, we can really see how this would affect the price. Yeah, we'd be up to about $123 per share. So some stellar growth in the stock price. Now, in the very worst case scenario where none of their projections come to fruition, they have further segment losses, monthly active consumers start to decline, etc. Let's say they're only able to grow at 5% for the first 5 years. That drops down to 0%. On a 30 PE, this stock will be worth about $4 per share. And really, this is what the issue is with Uber. It's an extremely expensive business for what they're actually able to produce. We're sitting at a market cap of $58 billion. Let's call it $60 billion when they have not even achieved profitability yet. Yes, they have a lot of things going for them, especially for the future, and they're planning on really 3Xing this business, but it's just not at that stage yet where we can accurately say that this is a value investment. A speculative play for sure, but I'm just not sold on the value investment just yet. But that's just my opinion. Let me know what yours are in the comment box below, and let's have a discussion. If you made it this far in the video, thank you for watching. Please like and subscribe, and I'll catch you on the next one.